Jim, we're seeing a big rally off of this Euro plan,
Right.
Dow over 12,000. How long does this rally last?
Well, I mean, I think that first of all, at any given time, these things could go down, if only because we're just up so much and we're very overbought. But I think that what will happen is that any dip this time will be bought, so that you have to be much more nimble. The idea, like that we had a couple times this month, but over and over again in September, that we would have like a down 300 day. I think that the people who need to get in won't let that happen anymore. I think one of the things that's been consistent until the last few weeks is that a down 300 day beget more selling, not less. And a lot of that was, although the people who do the ETFs would always disagree with this, that once you're down, when they settle up the down S&P double and triple leverage, it puts more pressure at the end of the day. I think that would now be overwhelmed, that pressure downward, by people who want to come in. Because we're at the home stretch here for this year, and if the Dow is up and you're down, that's all investors are going to think of. They're not going to say if the Dow's up 1, you're down 1. They're going to say, oh, the market made money and my guy lost money. So the only way to make up that performance is to buy, and that's what I think is going to keep it so that you've got a decent market here.
So we won't have the down days of 300, but we might have an up day of 300.
Yeah, I mean one of the things that I think when you look at it, we're almost done the big data points. I mean, think about what's going to happen here. Unemployment's never gotten better, so that's going to be kind of, as a macro story, not that good. Housing isn't going to get better. The macro story, not that good, but we're kind of used to those now. Like, we now just go ho-hum on a 400,000 job claim. I mean, it should be like, wow, that's bad, but we don't. We go ho-hum on new home sales. It doesn't matter. What will happen is that we'll extrapolate what these companies' quarters were. We'll say that there's nothing new other than the fact that it seems like inventories were pretty low. We'll continue to see monthly retail sales numbers, and I think those will be quite strong because people, there's been a lot of spending. Some of it is because people aren't paying their mortgages and they're spending, and some of it is the unemployment benefits. And the bears will have to hang their head on the super committee failing. And I don't think it's going to fail. I think it's going to surprise people, and I think people after this Euro deal are going to be more worried that it might pass than that it might fail, that they might do something.
So now, as an trust government leaders again, that's kind of surprising.
I know.
So then, as an investor, then what do you do when you have a rally like this? Then when you have slight pullbacks?
Well, I mean, I think you have to, technology is still very, very low versus where it could go. Let's use that as a metaphor. Let's say that the inventories are low for glass, is what Corning told me last night, Jim Flaws. The inventories are low for semiconductors, what Avnet's saying today. The inventories are low for semiconductor equipment, what Novellus said last night. What you're going to see is a kind of radical shift into these stocks, whether it be Qualcomm or Broadcom, which just, Broadcom reported a good quarter, but then it gave a very bad outlook because of macro. Well, we're just going to ignore that outlook now. We'll ignore that outlook for Qualcomm. We'll now start saying that the Apple i4S is going to be selling well. Apparently it is. That stock paid its dues. It went from 420 to 390, a big decline. I mean, I would have thought it would go into 380, but intraday you could keep, you had one of these things. So, I think that sector. Second sector is banking group. Now, I don't like the banks, but I do like certain banks, and the big overhang there was Europe. Our banks have really very studiously avoided Europe. We didn't think they did going in, but they have. They're levered to housing, which isn't good, and they're levered to unemployment, which isn't good, but the last 25% drop was Europe. And if you take away Europe, those stocks can run. So banking and tech are well behind the market for the year, so I think people are going to gravitate to those.
I noticed on Mad Money the other night that you said that you had a technician on who was saying that the reverse head and shoulders pattern for the banking stocks could really ignite a rally.
That's Ed Ponce. He writes Parchetta Capital. He writes for Real Money, and that was a well-timed call. The week before, we had Bert Doman. Bert Doman had been very, very negative. And at 3 o'clock, right before I went on, he said, look, I followed Bert for years. LinkedIn letter, and he said, look, this is a very powerful, we just have a very powerful reversal right here, and this is it. We're going to have a year-end rally. Now, why do I point out these technicians? Because if you don't have any new data after the quarters reported, what people do is default to the charts, and the charts have been very negative. So you had a lot of money that's kind of quietly playing a bear scenario off the charts, a lot of money playing a bear scenario off of the idea that Greece, it was a 20% haircut. No way they're going to admit to 50, and there's no way they're going to do a $2 trillion, $1 trillion package, $1 trillion euro package, and they have. The exposure to Europe is probably so low that even those stocks will rally for a while. That's what you would sell first. But if you look at the charts of banks and semis, they haven't done anything at all. So they're a natural place to go.
All right, so catch up plays, tech and banks. Thanks, Jim.